Hey everybody, I hope everyone is doing well and had a good day. In this video, I will review the Emini 5-minute chart for Wednesday, November 5th, 2025. There was a small gap down on the open. And if we look at, there's a couple of things I want to talk about really quickly before I get into the day, actually, and that's on the daily chart. The reason I have a horizontal line drawn here. And this is the RTH chart, regular trading hours. We had a gap down into the open of yesterday, a big gap down. And that's really just a breakout. A gap and a breakout are the same thing, a space between two prices. So we have the close of the prior bar, the open of the next bar, big space between them. It's no different than a big trend bar, a bear trend bar. And the Globex chart should show that. So there's the breakout bar. And the reason I have this horizontal line is because you can see the market sold off to this line and bounced, gapped up, sold off again, bounced, sold off again, and then finally broke below it. So this was an area of support, and then the market broke below that area of support. The reason I chose the 30th of October, it's just a best fit support line. At the time it was support. Each of these three bars touches that area of support, seems to react to that line of support, and then we broke below it. So I'm expecting this area to be resistance because the market broke below it. So any trader buying here got trapped on the bear breakout, and support becomes resistance. You can see the test at the high of the prior day, and then we'll get into it today. That's what this line is up here. So a small gap down into the day. And if we talk about the context at the end of the prior day, we have a wedge bottom. And it's nested. You can see it a couple of different ways. 3 legs down. So 3 small legs here, 3 bigger legs here. And the amount of overlap, at this point, the market is in a trading range, transitioning into a trading range. It's a bear channel at the time. So contextually, on the open of the day, it's probably always in long. But if you're waiting for price action to confirm the always in direction, then it's still a bear channel. Maybe it's always in short. Although if you're selling down here, you're selling leg 3, nested leg 3, late in a bear channel. So not ideal for selling. So always in long because of context. But if you're waiting for the price action, you need to wait for the big bull breakout and follow through. So on the close of 4, and certainly on the close of bar 5, the market flips to always in long. And this is a dominant feature of the chart. If you look at all the bars to the left, bars 4 and 5 today, they're clearly bigger than the range of all the bars to the left. And they're also closing, bar 5 closing far above all these bars to the left. So breaking above a trading range. This is probably going to get some sort of reaction, meaning a second leg up at a minimum. And you can see through here, the market transitioned into a trading range and ultimately became, you can call it a double bottom bull flag, pulled back, higher low, 22, leading to a bull breakout. The selling pressure through here, pretty weak. You have a couple of bear bars, 9, 21, really only 9 closing on its low, and none of the bear bars getting follow through. You also have open gaps. If we look at the breakout point, the high close back here, none of the bars closed below this line. So the bulls were able to keep the gap open on the line chart that plots the close of bars. So 55 high, or the 55 close yesterday, area of resistance. Last time the market was here, we sold off, tested again, sold off, tested again. This time we broke through it, and then it became support. So this is another example of where resistance flips to support. It's the opposite example of the daily chart. So bull breakout, Bulls hold the market above the moving average. So even though there's a lot of two-sided trading, the bulls are keeping just about every bar completely above the moving average. After going sideways for 15 to 20 bars in a trading range, eventually one side gets squeezed out and the market breaks out again. So this is just the nature of price action in the volatility cycle. Volatility expansion, volatility contraction, volatility expansion. The market breaks out and then forms a channel. The channel evolves into a trading range, and then the trading range leads to a new breakout. So breakout 5 and 6, pullback on 7, which began the channel phase, channel up to bar 15, evolution into a trading range, and then a new breakout in the direction of the trend. Remember, the open gap, the buying pressure was stronger than the selling pressure, so it was more likely the trading range here would lead to range expansion in the direction of this big breakout. It still needed a second leg, and it got it here. So symmetrical second leg, 23 through 29. I want to talk about bar 25 because I think there was a bit of a surprise here. At the time, bar 25 may have been seen as a late leg to some traders. Some computers count 3 or 4 legs up to bar 25. And when the market has 3 or 4 legs in a channel, usually the third leg pulls back deeply or reverses into a trading range, maybe even an opposite trend. Especially here, 23, 24, 25, bull momentum seems to be getting weaker. Big bar followed by a much smaller bar, and then an even smaller bar, 25, in a late leg. Now if you're selling, it's better to wait for the stop order signal, which the bears never got. But the bears who are selling with limit orders, maybe they're selling new highs, they sell above 15, they get trapped on the breakout 25, maybe they're quick enough to use 26 to exit, and then there's the give up 27. So we're getting a bull breakout above a bull channel line in a late leg. Generally low probability event here. This traps traders and leads to another leg in the direction of the breakout. So the breakout getting more follow through. Probably this leg resets the market cycle to some degree, similar to 4 and 5. So this needs its own second leg. And then what about this sell-off down to 32? You have to ask yourself, is it a major reversal or is it just a minor reversal? A minor reversal is a pullback and it's a flag. And when we're talking about a minor reversal in a trend, you're expecting the market to have a shallow pullback, transition into a trading range, best case scenario for the bears, and then lead to trend resumption in the direction of the trend, the major trend. So resumption back up. Also the structure of these 3 bars, 30 through 32, you can see the market sold off on 30, had a deep pullback, 31, sold off again, closed on its low, pulled back again, sold off, closed near its low. This is 3 legs down on a smaller time frame. 28 is a breakout bar. The high of the prior bar is support. So 28 breaks out far above the high of the prior bar. Any trader, and again, this goes back to the theory that this is a fundamental premise. There's a trader buying and selling on every tick of every bar. So in theory, some unfortunate bear sold the high of bar 27 for whatever reason, and they got trapped on bar 28. And what's a bear going to do if they sold 27? They're probably going to scale in higher and hope the market comes back to their original entry price, where they'll take profits at their original entry. They'll close the position at their original entry, break even on the first entry, and with a profit on their scale in. Market slowly, in 3 attempts, approaches that bar 27 high, And logically, you have to ask, what are the bears who got trapped here going to do? They're probably going to buy back shorts. So the bears are buying, the bulls are always buying, and the bulls know that the bears are trapped, and they're getting squeezed out here. And that's why there's only a shallow pullback. When there's a strong breakout, there's a demand for a shallow pullback. Traders are desperate for a pullback. Bears desperately waiting for this pullback to exit with a smaller loss, maybe break even. And bulls, they want to get in on the breakout and capture the second leg. So bulls and bears buying 3 legs down to breakout point here, which leads to another leg up. Now I mentioned this horizontal line, it's higher time frame context, resistance. It's just a general area, so it's okay if it's not a perfect resistance area. The idea is just to be aware that on the higher time frame, we're probably testing an area of resistance. We should also have the high of the prior day here as well. So structurally, we have 3 big legs up to an area of resistance here. So the bulls might be exhausted after 3 legs. And this is not, generally speaking, this is not sustainable buying. This is a buy climax followed by a pause, buy climax, pause, buy climax. It's not really sustainable small pullback trending behavior. And big picture, this might be, even though there are open gaps, if we look to the left, big up, big down, big up, this might simply be a wide trading range. So we're getting a third leg up. But the danger with buying up here is you're buying a late leg at a major or higher time frame resistance area. You're far above the moving average. So if you're buying here, you're buying momentum. The only way you can justify buying here is your premise is you're buying momentum. You need strong bull bars. You need sustained momentum. If the market starts to hesitate and pull back, then that basically invalidates your premise. How can you justify buying so far above the average price in a late leg if you start getting hesitation? So a lot of bulls might bail out at any sign of hesitation. And typically the default exit here, if you get a bear bar closing on or near its low, maybe even below its midpoint, it's probably better to just get out and look to maybe buy lower, which is what we get on bar 40. So a default exit for me, this is something Al talks about in the trading room. If you get a bar like 40 in this context, 3 legs up, climactic, bull legs far above the moving average, probably better to just get out here below 40 and wait for more information. It doesn't mean we're going to get a major reversal here. It's just that the third leg can pull back deeper. And there's a breakout point here. Maybe the market tests back down here. Maybe it tests the start of the third leg back down here. 5-6 bar micro channel. Probably will get a second leg down. Double bottom. It's a high 2 in a bull trend, 45. But a tight trading range after a late leg. Again, at that resistance area on the higher time frame. So it may be good for a scalp, but you also have trapped traders now back at the high of bar 38, the close of 38. Bulls buying closes here, making money until bar 39. Then they get trapped on bar 40. So now there's resistance up here. And you can see 46 testing that price straight to it and then reversing back down. High 3, 48, tight trading range, testing this area again. Upside here probably limited. It might still be a bull channel, but it also could be transitioning into a trading range at this point, and maybe now it's a 4th leg up. So not ideal for buying. 51 again, if you're long, probably just get out below 51. Couple legs down, testing support. Downside here, probably limited. So big bars, 55, 56. Is it always in short? It might be always in short. Consecutive bear bars closing near their low, crossing the moving average. But if we look back at the bigger picture, tight channel, maybe 2 legs down, 1, pull back, 2, and testing that breakout point. So you also have the possibility that this is transitioning into a trading range and it's a second leg trap. 1, pull back, 2. And then where's the market testing? It's testing an area where the bears got trapped. Bull breakout, strong breakout above this swing high. Bears selling here get trapped into a losing trade. They're desperate for that pullback, and this becomes support. Bulls and bears will buy here. So 57 reversing up. So it might be always in short, but doesn't necessarily mean it's an ideal place to sell. But this probably needs a second leg down. This is enough selling to disappoint traders above, and so this might be a trading range, and it's become buy low, sell high, and right now we're low. And where's high? Well, this general area, there's yesterday's high. That high close, maybe this breakout point, layers of resistance above. The reaction to that one, 54 low, breakout point, strong enough for a second leg. Maybe that's all the bulls get, transitioning into a very tight trading range. We've gone sideways for enough bars here. It's been about 20 bars sideways, maybe even more. At this point, that the breakout direction, the next breakout is about 50-50. It could be to the upside. It also could be to the downside. Tight trading range continuing, breakout mode. Also getting late in the day, not ideal for trading. Tight trading range, end of day. Maybe better to just sit back and watch what happens. Bears getting the breakout, many consecutive bars closing on their lows. Good for the bears. Is it leg 3? It might be leg 3, so not ideal. Let me clean up the chart a little bit. Maybe not ideal for selling here. You might be selling low in a channel, but this is strong enough that it's probably going to get its own second leg at a minimum. And the buying pressure through here, really non-existent. Where are the bull bars? Where are the tails below bars? They don't exist. Bears breaking below that channel. There are other magnets below this breakout point here. Also this trading range, maybe the midpoint of this trading range, is also a magnet. So the breakout point, the midpoint of this trading range, magnets below. Give up bar, 78. Big trend bar probably will lead to 1 to 3 bars sideways. This is going to attract profit taking. The bears who sold higher, they're going to take profits on a bar like 78. It's late in the day. It's a huge bar. They get a windfall of profits. They're going to take it. You can see 79 testing that middle of the trading range there. And that's about it for the day. So that's it for the end of day review. I hope it was helpful, and thank you for watching.